India wasn't supposed to be winning at digital payments. Not a country where cash ruled for decades. Not a country where small transactions and informal businesses dominated everyday life. And yet, something counterintuitive was unfolding. People weren't upgrading from cash to cards. They were skipping cards altogether. Debit card usage started falling sharply. Meanwhile, a system built inside India was doing numbers no one expected. UPI was processing billions of transactions every month across street vendors, auto drivers, kirana stores, and online platforms. Payments that once needed cash, cards, or bank details now took a few seconds and a QR code. Just 10 years earlier, most Indians didn't trust digital payments at all. Mobile phones weren't payment tools. Cash was king. UPI flipped that reality not by copying Western systems, but by ignoring them. It didn't make people learn new habits. It fit into the habits they already had. That's how a country written off as technologically behind ended up building one of the largest real-time payment systems on the planet. Before credit cards, spending had limits. If you didn't have cash, you waited. Or you didn't buy. In the 1950s, banks spotted the problem. Consumption was capped by what people carried in their wallets. So they introduced a simple but powerful idea. Buy now, pay later, everywhere. The credit card wasn't just a payment tool, it was a behavior hack. Early adoption was slow because people didn't trust plastic money. So banks forced the issue. In one of the boldest marketing moves ever, thousands of credit cards were mailed directly to households, pre-approved, ready to spend. Once people tried it, they didn't go back. Consumers spent more. Merchants saw higher ticket sizes. Banks earned interest and fees. As usage spread across cities and countries, individual banks couldn't scale alone. That's where networks came in. Visa and Mastercard emerged as neutral layers connecting banks and merchants worldwide. They didn't lend money themselves, they built the rails, every swipe routed through their networks, every transaction paid them a small fee. Individually invisible, collectively massive. Over decades, this model turned Visa and Mastercard into the default payment infrastructure for the world, not because they owned money, but because they controlled how money moved. By 2009, India had 1 billion people and almost no digital payments. On average, an Indian made just 6 digital transactions a year. In the US, that number was already in the hundreds. The problem wasn't awareness, it was friction. Only a few retailers could accept cards. Machines were expensive, fees were ongoing. And for small vendors, the math didn't work. When your average sale is 20 or 50 rupees, losing even 2% meant losing money. Bank transfers weren't easier. They required account numbers, IFSC codes, and blind trust. Mobile wallets worked only if both people used the same app. In short, digital payments existed, but none of them fit how India actually transacted. That's when regulators reached a hard conclusion. India couldn't copy Western systems. The economy was built on tiny, frequent transactions. Cards were never designed for that world. So instead of fixing cards, India built something else. In 2009, NPCI was created to treat payments as public infrastructure. In 2016, UPI launched. At first, it barely moved. Then this happened.
500 रुपए और 1000 रुपए के करेंसी नोट लीगल टेंडर नहीं रहेंगे.
Demonetization forced the country to experiment. QR codes went everywhere. Cashbacks followed, adoption exploded. In 2 years, UPI transactions jumped thousands of times over. The underdog finally had momentum. UPI didn't explode because it was brilliant. It exploded because India was pushed. On November 8, 2016, most of the country's cash became invalid overnight. Suddenly, cash wasn't reliable. For millions of people, it wasn't even usable. UPI offered a workaround. A shopkeeper didn't need a machine or paperwork. A printed QR code was enough. Payment apps piled on with cashbacks and incentives. What started as experimentation turned into necessity. Then, just as cash began recovering, COVID hit. Handling notes felt unsafe. ATMs felt risky. Physical contact became a problem. UPI wasn't just convenient anymore. It was contactless, fast, and already familiar. Demonetization introduced people to UPI. COVID turned it into muscle memory. Once payments become a habit at population scale, they don't reverse. That's when UPI stopped being an alternative and became the default. At its core, the card business survives on one thing: the middleman. When you swipe a card, your bank and the merchant's bank don't talk directly. Visa or Mastercard sits in between, verifies the transaction, and takes a cut. That small percentage built a $1 trillion business. UPI breaks this entirely. With UPI, banks communicate directly through NPCI's infrastructure. Money moves instantly. No private network takes a fee in the middle. That's why debit cards collapsed first. In India, they slowly stopped being payment tools and became ATM cards. For a while, credit cards looked safe. Then India went after that too. Banks began issuing RuPay credit cards linked directly to UPI IDs. No card numbers, no global networks. You scan a QR code, choose credit, and your bank handles the rest. The risk stays with the bank. The rails stay public. This isn't competition with card networks, it's removal. The real impact of UPI goes beyond convenience. When global sanctions shut down card networks in entire countries, one truth became obvious. Payment systems are geopolitical tools. If your rails belong to someone else, your economy is exposed. UPI changed that equation for India. It turned payments into sovereign infrastructure, controlled locally and designed for scale. And instead of exporting control, India is exporting a model. One where countries build their own systems, but all of them can talk to each other. UPI doesn't need to dominate the world. It just proved that the world has another option.